Hello, well, my name's Perret, and I suppose to position why I was talking so much about R&D tax incentive, that is my day job. But I also am involved in many ways in the innovation system in Canberra through my role on Capital Angels. I'm on the Canberra Business Council Innovation Task Force, and also the Digital Canberra Challenge Program Board, which is an ACT government program board. So my role today is with my Capital Angels hat on, and the first technology trick I have to learn, like every other presenter, is which way these go. There we go, now I know. So I'm here to talk to you about what an angel investor is and when you might, if you're starting a business, access an angel investor. So essentially, they're high net worth individuals and they have money to invest. So that's always good if you've got a business and need money. Angel investors are experienced business people. Often they have built businesses themselves and successfully exited them. So angel investors are interested in, I suppose, giving back, obviously with an aim to make money themselves, but they're also prepared to invest at a much earlier stage than most other investors. Some people are angels by chance. You might have people within your network who, an uncle or somebody like that who believes in you and says, yeah, I think that's a good idea, I'll back you. But there are also people who are angels by choice. They've decided that that's an asset class that they would like to invest in. They may well have done it all before themselves, so they understand the rigours of business, and they're always looking for a good deal to invest in. So why do they do it? Why do we do it? Well, personal satisfaction, especially here in Canberra. A lot of the angels have made a lot of money out of Canberra and like the idea that they can give back by growing other businesses. They do get financial rewards, mind you, a lot of them don't. I think two of our most experienced angels here, I remember Nick McNaughton's story about he has a $65,000 baseball cap. That's all that he's got left to show of a $65,000 investment in a company. So it certainly is high risk, but there's also high reward, both personally and financially in many occasions. So what does an angel investor offer you? Well, first and most important is money, usually as an equity investment. But angel investors can also be useful because they are what you call smart money. Usually in the funding cycle, and I do have a slide on that in a minute, which I think will be of interest to you, you start off with what we call family, friends and fools. And that's not to diss family, friends and fools. They're very important to get you off the ground. But then comes a time when you need another tranche of money, but you probably just don't need the money on its own. You need the experience. You need someone who's done it before. You need someone who understands commercial realities, who's prepared to roll up their sleeves and, I guess, get their hands dirty in your business with you. They are valuable sources of advice and mentoring, but also they can be valuable sources of networks because they know who to talk to. And that can be, as it says there, customers, suppliers. They can be a valuable asset to a board and bringing other board members into the company. And I think that I would find that in most instances when we have people pitch to Capital Angels, they are looking for that mentoring, that experience and that network pretty much as they're looking for the money. So, what will an angel investor look for? They do want to see that you have a business with a strong market opportunity. They do want to see that you have a clear and realistic go-to-market strategy. This is probably the first time when you're really going to be tested on what sort of research you've done on your business opportunity, the market, the numbers, how they stack up. They do want to see a capable and enthusiastic initial team, but they also want to see that you're someone who is prepared to understand when your skill set is exhausted and you need some other skills on board. So the enthusiasm and the drive is very, very important. You've got to be able to sell your story, but you've also got to be able to realise that in growing a business there's times when you'll have some hard lessons that you have to learn, so you'll have to be prepared to learn those. They also want to understand what you've done about protecting your intellectual property, and they will also do a risk rating on the organisation. Now, remembering they will invest in very high risk ventures, but they've got to believe in your story and believe that you can achieve what you're setting out to achieve. So when do you need them? Well, as we've already talked about the 3 Fs, after that initial stage when you're getting the idea off the ground, you might be bootstrapping it through consulting or another salary you have on the side, you might have family, friends and others investing in you. You're too early to seek funds from early stage venture funds, and but you do need to have a business plan and some customer validation, or some initial customer validation. Ideally, if you can point to someone who's willing to buy your product, or you're about to enter into a trial or testing phase, the example of QHopper with Brotberger is a great one. That's they're working with Brotberger to get that up and going. There will be reward for them from Brotberger at a point when it's going, but Brotberger's giving them an opportunity to get it going in a real live situation, and that's something that an angel investor would be very interested in understanding in terms of your business. Usually from angel investors they would be prepared to put in between $50,000 to $200,000. That's the normal size in Canberra. However, there have been some much larger investments made. And it was on the 19th of March, Capital Angels, we held a capital raising masterclass. It was a whole day event, and we put some statistics together with the ACT government, and the angel investors from Capital Angels in the previous, I think we were looking over a 10-year period, had invested well and truly over $1 million, but from angel investors across the ACT, the numbers were much closer to the $10 million. So there has been a lot of money invested through angel investors. So, this is an interesting slide, and I don't claim credit for it. I have to give the credit fairly and squarely to Murray Rankin, who does this presentation extremely well. But just for your interest, it shows you the typical funding cycle and highlights the infamous valley of death, which is where most companies fail. So you start off with your invention and getting money from those family, fools and friends. As you can see, that can go from invention through early stage commercialisation right up to commercialisation. Typically, you'll note from that slide that somewhere between invention and early stage commercialisation, angel funding and high net worth individuals will be the sorts of dollars that you'd be seeking. Venture capital probably really kicks in at about that early stage commercialisation and goes right through to the growth phase. There's 2 types of venture capital, it's worth noting. One is the early stage venture capital versus the bigger VC funds that do come in at a later stage. The distinction between early stage venture capital and venture capital is largely around the tax treatment of the different funds, and obviously the early stage one is precisely that, meant to come in at an earlier stage than a normal VC would fund you. Private equity, debt and public markets, so public markets being listings, which is often the holy grail. It's not necessarily the right decision for every company, but it often is the holy grail, tend to come in around the time that you've got a commercial product and you've commercialised and through your growth phase. Now, in terms of the government funding that we've been looking at, the R&D tax incentive, if you're doing research and development, you could be receiving funding through the R&D tax concession right the way through that cycle. Companies don't tend to just stop doing R&D because the invention's done. By that stage, if you really are a growth company, you're working on the next invention. In terms of things like Commercialisation Australia, that would be around the early stage commercialisation on that chart, probably similar to where the angel funding and high net worth comes in, through to the commercialisation. And with ICON is typically at that very early stage between invention and early stage commercialisation. So hopefully that just gives you a view of the funding landscape, as they call it, and what every company wants to do is make sure they've got themselves in a position so they can straddle that valley of death, which is the trap where a lot of companies find they have their invention to a stage that's not quite saleable, and unfortunately they're burning money at an enormous rate and eventually run out. So the aim of the game is to make sure that you're not only looking to get your technology or your service or your business out to market and have paying customers, but looking at what other sources of funding you can get during that period. So there we go.
Well done.